All right, good morning or good afternoon to everyone. Thank you for joining today's presentation. I've named it the three pillars of a successful retirement plan, mainly because I think that these three areas apply to pretty much every retiree here that could be watching or getting close to retirement. So there's three key areas that we'll focus on in today's webinar. A couple kind of housekeeping items just to start with. Always want to just explain again up front who this webinar is for, who this presentation is for, so that we make sure that we're being respectful of everyone's time here. So if you don't meet these criteria, then maybe this isn't a good presentation for you. But anyway, this webinar is for people who are recently retired or within 5 years of retiring. You've been a diligent saver and investor throughout your career, whether you're working with an advisor or doing it yourself. But you're not confident in that next step of preserving your wealth and learning how to sort of distribute it to, again, provide that income for your retirement. A couple other things that would apply to people who this webinar is for. You want to minimize your tax burden in retirement, or you're not sure how taxes will even apply in retirement, since, again, decumulating your nest egg is a lot different than the accumulation phase. So minimizing your taxes is a big part of that we'll go over. You want to maximize your retirement spending. You've worked hard for all this money that you've saved and invested for your retirement. You want to get the most out of it, whether that means leaving a legacy to the next generation or just spending as much of your money as possible in your early and healthy years of retirement. So that's number two. Number three is you want to understand how your nest egg should be invested in retirement and have a plan for when, not if, the stock market takes a dive. Historically speaking, there's been a bear market every 4 years or so. So obviously in retirement, that's still a 20, 30-year period of our lives. There is going to be stock market volatility. So you're someone who wants to understand how to navigate that and how to invest your money in a way that's going to allow you to, reach those goals that you have for retirement, but not take on too much risk that will, cause you to stay up at night. So that's kind of the three sort of areas that we'll focus on and who this webinar, again, is for. And then before we jump in, just a quick agenda. So again, the first step that we'll cover is your retirement income planning, which will include things like Social Security, something called the retirement spending smile that we'll go over. And then we'll talk about the traditional retirement income methods, such as the 4% rule and using Monte Carlo projections, which are sort of traditional retirement simulations that many people use, whether it's DIY or financial advisors use with their clients. So we'll talk about some flaws in those traditional methods and a newer, more modern approach to retirement income planning. And then step two or section two of the presentation here will be about tax planning. Again, minimizing your taxes throughout retirement, whether it be through Roth conversions, a strategy called asset location, which is very important and not a lot of people are aware of, and then a withdrawal sequence. In other words, in what order do you pull from your different accounts in retirement to, again, minimize taxes depending on your unique situation. So, and then the third pillar, again, is investing in retirement. So we'll talk about how to align your investments with your goals. We'll talk about evidence-based investing, and then we'll also talk about focusing on what you can control in retirement. Investing has a huge emotional aspect to it, so you got to always try to focus on what you can control and sort of trust the markets in some situations to do their thing as they always have. So again, that's a brief overview of our agenda for today's presentation. And before we go into retirement income planning, I always like to discuss, why this is important in the first place. So with my clients at my firm, I always like to start with their purpose, or your why, as we like to call it. So, what do you want to do with your retirement? What brings you the most fulfillment? What is the money for? You can't just start talking about investments and taxes without knowing how it fits into your life and, how you want to use that money. So your why is always a place I like to start with, why this is important. And then again, moving from saving to spending is a huge emotional transition that a lot of people struggle with, at least in my experience. So hopefully by the end of this presentation, you will have a better understanding of, that confidence and that sort of clarity needed in order to make that transition. Some of the key challenges with retirement planning are longevity. Obviously, nobody knows exactly how long they're going to live for. Market volatility. Again, no one can really see the future. Nobody has a crystal ball with the stock market. So there's a challenge in that, navigating what stock markets are going to do and how it relates to your investments. Inflation is another thing that's a key challenge. Pretty much everything you buy this year is going to be more expensive next year and the year after that and the year after that. So it's very important that we plan our retirement to combat inflation and keep up our purchasing power with inflation. A lot of people struggle with finding that fulfillment in retirement. As we transition from the workforce into retirement, a lot of us lose our sort of identity and sort of self-worth when it comes to, what we're here for. A lot of people tie their identity to their work, so they struggle with sort of transitioning to that next period. So again, sort of part of this presentation is to help you, find that fulfillment. Another reason retirement planning is important is because making mistakes are often irreversible, and they can cost you in time or money, whether it be lower returns or missed opportunities for a specific tax strategy, or not being able to retire as early as you might have thought. So again, by avoiding those mistakes from the beginning, you can sort of set yourself up for success and retirement on your terms. And that leads right into avoiding regret. You definitely don't want to reach the end of your life wishing that you retired earlier or spent more money. So the retirement income planning piece of this presentation will address that. And lastly, I just want to say, if you are taking the initiative to look at this or watch this presentation, you're doing better than most. I've been in the industry for quite a while, and I can tell you that a lot of people go into retirement underprepared. So by taking that initiative and starting to learn more about what you should be doing for retirement, you definitely are doing better than most. So I definitely commend you all for that. So with that said, let's dive right into it. Number one, again, is retirement income planning. That's my first pillar here. So what is retirement income planning? I define it as coordinating all of your income sources that you're going to have in retirement and starting to sort of create a plan for when to claim Social Security, how pensions fit into the picture, and your portfolio withdrawals, which is sort of the big variable here, because Social Security, pensions, rental income, those are typically going to be fixed income sources that don't really change once you've started them. They might adjust for inflation, or your rental income can change, of course, but the portfolio withdrawals are really the piece of that's going to vary quite a bit. So that's the most important piece to kind of address for your unique situation. But just a note on Social Security, since that's going to apply to most people watching this. Social Security, you claim that based on your full retirement age, which you can see in the chart over here, does depend on when you were born. At full retirement age, you will receive what's called your primary insured amount if you claim it at full retirement age. If you claim it early, you can claim it early as age 62. If you did claim at 62, your primary insured amount is reduced by 30%. You can delay Social Security as late as age 70, in which case you would have an increased benefit by up to a maximum of 24% beyond your primary insured amount. You can claim Social Security anytime between 62 and 70, but those are just sort of the main ages that people focus on. A lot of people will claim at 65 as well, because that's when you get Medicare. Key factors to determine when you should claim Social Security are going to be your other income sources. So again, if you have any pensions, rental income, or a significant portfolio that you can withdraw from, your unique health, your health situation, how long you expect to live, and as well as spousal and survivor benefits. So your spouse, if they have their own Social Security benefit, that could play into when you should claim yours, as well as maybe an age difference between you and a spouse and which one you expects to pass first. That all has certain factors that go into when you should claim your Social Security benefit. If you haven't already, no matter what age you are, if you're pre-retirement, I would definitely recommend going to ssa.gov. You can get an estimate of your Social Security benefit in a matter of minutes. So that is a huge first step into your retirement income planning. So a common retirement income strategy is known as the 4% rule. If you haven't heard of the 4% rule, it essentially says that you can withdraw about 4% of your beginning portfolio balance at retirement and then adjust it for inflation each year without a significant chance of running out of money, based on historical market returns. It does assume a couple of things. It assumes you have a 50-50 portfolio, meaning half in stocks, half in bonds. Specifically, the study uses U.S. large cap stocks, so the S&P 500, for example, and then U.S. intermediate term treasuries as your assumed portfolio. It does assume that all of your money is in a pre-tax account, which is not always the case for most people. So if you've done saving outside of your 401k or an IRA, you're probably going to have other money in a brokerage account, maybe a Roth IRA as well. So it also assumes a 30-year retirement, which again is not really applicable to some people. Some people retire earlier than that. Some people will retire later than that. So these are, again, a few of the assumptions and why I don't think it's a perfect approach for everyone. It's an okay starting point, but as you'll see in here in a minute, there's a few flaws in it. So the rule's author, William Bengen, essentially did a back test of the 4% rule. So it is based off of the worst case scenarios. Over every 30-year period, if you withdrew just 4% of your portfolio per year and adjusted it for inflation, you would have pretty much a 99% chance of not running out of money based on that 50-50 portfolio. So my point in saying this is that there were plenty of 30-year periods throughout history where you could have withdrawn 5, 6, or even 7% of your portfolio each year and still not run out of money. Obviously, that may be a little aggressive for most people, but again, in most cases, it is overly conservative. So the other pitfalls I think that apply to the 4% rule is that it does not account for taxes and fees. Even if you're DIYing your retirement, your fees are probably going to be pretty low, but not zero. So, you definitely have to account for fees in your withdrawal strategy. And then taxes. Taxes are going to apply to everyone. When you're withdrawing money from your 401k or your IRA, you have to consider taxes here. And then the last sort of pitfall with the 4% rule is that it assumes that you're going to spend the same every single year in retirement, which is just simply not the case. We'll see in just a moment that there's a study that has been done that shows retirees spend money in different phases throughout retirement. So another reason I don't think it's really the best approach for your retirement income strategy. So if you backtest the 4% rule, this is basically a chart showing every possible outcome based on every historical 30-year period. This study was done by Michael Kitces, who is a renowned financial planner in the industry, does a lot of great work, research and studies like this. But essentially, this black line at the bottom here is your starting principal at retirement. So let's just say, for example, you have $1 million. You start withdrawing that 4% during retirement, and then you adjust it for inflation each year. But since your portfolio is likely to continue growing over time in retirement, you're still going to have a lot of money left over by the end of a 30-year period. So as you can see at the bottom here, not one of these scenarios results in you running out of money. There's the zeros at the very, very bottom here. But at the same time, over 2/3 of the outcomes result in you having more than double what you actually started with. So if you look at $2 million, that second line here, all of these lines above that are you reaching the end of your life with more than $2 million when you started with $1 million. So obviously this is where it can kind of lead to regret and underspending. If you reach your final years and you may wish that you retired earlier or spent more in your early years on more travel, whatever it might be. So again, this is where I feel that the 4% rule is a little bit too conservative in most situations, and there is a better way to approach spending in retirement. So to address how retirees actually spend money, there's a lot of studies out there that have shown that retirees spend money in 3 different phases. The first decade or so of retirement is known as the go-go years, which are those active early years where you're spending money on travel, leisure, whatever it might be, doing all those things that you've put off until retirement. Once you reach that sort of middle decade or so, you start to slow down, maybe become a little bit less mobile, less healthy, don't want to or can't travel as much. So you actually start to slow down your spending as it relates to inflation. And then in your final years, spending tends to pick up again for health-related issues and things like that. So this is a more accurate measure of how retirees actually spend money compared to the 4% rule, which just assumes basically it's going to be the same every single year. So the modern approach to retirement income and a retirement spending strategy that I think is better than the 4% rule is known as retirement income guardrails. Retirement income guardrails is a dynamic rules-based spending strategy that allows you to spend more of your hard-earned savings while still maintaining the goal of not running out of money. Remember, the 4% rules basis is you want to be able to spend without worrying about running out of money based on those historical scenarios. So guardrail still addresses that. What it addresses that the 4% rule does not is that it allows you to increase your spending based on how your portfolio is actually doing. If your portfolio is not doing as well as expected, you may have to make some small adjustments to the downside as well. But historically speaking, as we saw in that chart a moment ago, your portfolio over long periods of time is probably still going to continue to grow throughout retirement. So it allows you to start taking more money out of your portfolio if that does happen, that does come to fruition. So just to show you how this particular example compares to the 4% rule, if you were to start retirement with $1 million, you would be able to take out about $52,000 per year instead of $40,000, with the understanding that you will likely have to make adjustments at some point. And what I like, and a lot of clients that I work with like about this strategy, is that it has a clearly defined plan to preserve your portfolio when, not if, the market drops, because it is going to happen at some point in retirement. So by having this lower guardrail here, this sort of red panel that you can see in the screenshot, it says exactly what you need to do to preserve your portfolio if it drops to a certain level. And this ultimately also leads to less chance of regret later in life, because it does, again, allow you to spend more of your hard-earned nest egg while still, preventing the possibility of running out of money. So just a closer look at an example guardrails plan that we have here. So again, this middle dotted line here is your beginning portfolio or your current portfolio. If your portfolio increases in value, again, while you're withdrawing money, if it increases 18%, it allows you to increase your withdrawal rate also by 18%. And then the downside buffer is going to be a lot larger, meaning there would have to be a pretty significant drop in your portfolio to warrant any sort of decrease in spending, because nobody wants to go into retirement thinking that they're going to have to give themselves a pay cut at any point. So we purposely set that sort of guardrail much lower, so there's a much lower chance that you're going to have to adjust your spending to the downside. So for example, if your portfolio dropped 33% to $670,000 in retirement, you would have to cut spending, but only by 5% or so, because the idea here is that with every market downturn we've ever seen, the market does eventually recover, does come back. So you only really have to adjust your spending slightly to the downside to preserve your portfolio. So with retirement income guardrails, the buffer to the downside is much larger, meaning that there's a much lower possibility of reducing your spending and a much more likely possibility that you can increase your spending at some point during your retirement. So that's it for the first pillar, retirement income planning. Now we'll move on to tax planning. So what is tax planning? Tax planning is essentially using the tax code to your advantage to minimize your lifetime tax bill. Most people are familiar with tax preparation, which is basically looking at the past year and filing your taxes, making sure you're taking advantage of all deductions and credits. But tax planning is that forward-looking strategy of minimizing your tax bill. One example of that is Roth conversions. Roth conversions is simply, converting money from a pre-tax account like a 401k or a traditional IRA into a Roth account, which is an after-tax account. The idea with a Roth conversion is to pay some taxes today instead of more taxes later. Roth conversions are something that a lot of retirees can take advantage of. Most retirees are going to be in a lower tax bracket when they retire than their working years. Obviously, if you're earning $100,000 a year while you're working, and then when you retire, you only need $50,000 to live off of from your pre-tax account, that is, of course, going to mean you're in a lower tax bracket. But the issue here is required minimum distributions. So pre-tax accounts do require that you start taking money out later in life. This chart down here at the bottom shows you, based on your birth date, when you'll have to start taking those RMDs. But basically, since you're forced to take money out of those pre-tax accounts, it could increase your tax bracket back into one of those higher tax brackets, whether you actually need that money or not. So it can also affect things like your Social Security being taxed, and then Medicare surcharges as well. So that's the issue that Roth conversions tries to address. By converting money from those pre-tax accounts in your early retirement years, you're essentially reducing what is in those accounts and subject to a required minimum distribution. A good way to visualize this is on this chart here. The blue shaded area is going to be your income. As you can see, if this person retires at age 65, their income is going to drop significantly. There's still maybe some income from interest or dividends and things like that, but when RMDs start later at age 75, it's going to force their income back up into one of those higher brackets. So the sort of area in the middle here is what I call the Roth conversion valley. So anytime you plot your income on a chart like this and you see it drop significantly, that means there could be an opportunity to convert money to Roth while you're in those lower tax brackets, and then prevent that big spike up in taxable income later in life. Another example of good tax planning is going to be asset location. So asset location is placing your tax inefficient investments into tax efficient account types. So a couple examples of this would be putting your bond funds in your IRAs. IRAs are tax deferred vehicles, meaning the interest that you receive off of your bond mutual funds and bond ETFs will not be taxable inside of an IRA, whereas they would inside of a brokerage account. Interest income from bonds is basically going to be taxed as ordinary income, which is your highest tax rate. So another example of good asset location would be to put your high growth assets in your Roth IRAs, because in your Roth IRA, all that growth is going to be tax-free. You generally want to touch your Roth IRAs last, whereas if you had those high growth assets in your traditional IRAs, all that growth will be taxed later on. Now, you generally want to mix in each account, but generally speaking, you want to fill up your Roth IRAs first with those high growth assets, and then anything else that is part of your overall asset allocation should go in your traditional accounts after that. And then using low turnover investments, meaning using ETFs and mutual funds that are passive versus active, so they don't really try to beat the market. They're not doing a lot of trading underneath the surface, so there's less taxes involved with that as well. So an example of asset location would be if you want your overall allocation to be 67% in stocks and 33% in bonds, rather than investing each of your different tax buckets exactly the same, 6733, 6733, and 6733, can allocate different accounts in different ways so that your overall allocation would still be 67% equities, 33% bonds. But this way you're basically tucking away those tax inefficient assets into more tax-friendly accounts. So again, if you have your taxable bucket invested fully in equities, that would be like your brokerage accounts. You have your traditional IRAs and 401ks housing all of the bonds, again, those tax inefficient investments. And then lastly, you have your tax-free bucket, which would be your Roth IRAs. Over a 30-year retirement period, this can have a substantial difference in taxes owed and sort of adjusted ending wealth when it comes to your expected balances. So with this sort of example that I use in our financial planning software, a couple assumptions here. This is over a 30-year period, and this is assuming a 6.3% annual return from the investments. So I will say that efficient asset location is highly dependent on each person or each couple's unique situation, including your risk tolerance, your withdrawal needs, and your balances in each bucket, which would be taxable, tax deferred, and tax-free. But again, just wanted to show you a quick example of how asset location can save you a lot of money in taxes over your lifetime. And the next sort of subject when it comes to tax planning that I use in my own practice, and I wanted to make sure everyone understands here, is a withdrawal sequence. So just as we saw on the last slide, you have different tax buckets. The order and the combination in which you withdraw from each investment account for income through retirement can have a huge effect on the amount of taxes you owe as well. We'll look at another example in just a moment, but they all have different tax implications when you withdraw from each of these buckets. So again, for example, if you're withdrawing from your tax deferred bucket, which is those pre-tax IRAs and 401ks, all of that is taxed as ordinary income. Your Roth accounts are generally tax-free as long as you meet the two criteria, which is that you have the Roth IRA funded for at least 5 years and you're over age 59 and a half. All of those earnings and growth is tax-free from your Roth. And then your taxable bucket is, again, where any interest or dividends or capital gains are taxed in the year that they occur. So again, each bucket has a different tax consequence when you need to sell investments and withdraw money. So just to show you another example here, the general default sort of assumption that most people go to when it comes to their withdrawal sequence in retirement is to just withdraw from each bucket pro rata. In other words, if you needed $10,000 per month in retirement, you would take some from your pre-tax accounts, some from your taxable accounts, and some from your tax-free accounts, depending on how that money is allocated and spread out. But in this particular example, by withdrawing all of your income needs from your taxable bucket first, allowing your tax-deferred and tax-free money to continue compounding and growing, that can have a substantial difference. In this example, I think the starting portfolio is a little over $2.5 million, but over a 30-year period, you can save nearly $1.1 million, again, assuming a 6.3% annual return over 30 years. That is basically expected to save this person $1.1 million by withdrawing in that sequence compared to pulling money out pro rata. And again, the reason for that is because your Roth money you generally want to leave till last because that money can grow completely tax-free. So by pulling money from your taxable bucket, first, you're reducing sort of those taxable interests and dividends that are occurring each year. And then you're going to pull from that tax-deferred bucket second to, again, limit your RMDs later in life and use that money, draw that money down so that your Roth can keep growing. So again, the most effective withdrawal sequence is highly dependent on each person or each couple's unique situation, including your risk tolerance, withdrawal needs, and your balances in each bucket. But this is a real example I wanted to show you of sort of how these effects, how these decisions can compound over time and ultimately result in a huge difference by the end of your life. So that is it for tax planning. The next and last pillar here is investing in retirement. When you retire, your approach to investing should change. Generally, your risk tolerance is going to be lower. You no longer want to see wild swings in your account as you start to rely on that money for income. Your investment objective usually changes since, again, you want to start receiving income from your investments and maybe are not as concerned with growth over time anymore. And then your time horizon changes. So when you're in your 30s or 40s and you still have 20 plus years until retirement, you can sustain those market fluctuations knowing that there is plenty of time for it to recover. But your time horizon shortens a lot when you retire because you start to need withdrawals from your account. So at least a portion of your investments should be reflective of that, needing that money, as time goes on. So I will say that a lot of people I've talked to throughout my career think that when they retire, they should stop investing because they need that money to be 100% guaranteed and there for them. But investing is still of the utmost importance in retirement because inflation doesn't stop when you retire. One of the main reasons we invest in the first place is to outpace inflation because, once again, everything you buy this year is probably going to be more expensive next year and the year after that. So you still want to have at least some portion of your money invested in growth assets so that you sort of outpace inflation over time. You also will have more spending power over your lifetime by keeping money invested and growing. Whereas if you had everything in cash or in the bank, you're likely not going to be able to spend as much on a yearly basis because you're going to draw down your nest egg much faster than generally if it was invested. So, and then lastly, if you have any legacy goals and you want to leave money to the next generation or to a charity, by investing over retirement, which is still a multi-decade period of our lives, you're likely going to leave a lot more money to that next generation or to that charity of your choosing. So that's just a little excerpt about why investing is still important in retirement. So as I mentioned in the very beginning, the first thing you want to do when it comes to looking at your investment strategy in retirement is align your investments with your goals. And what I mean by this is, do you want to leave a legacy to the next generation, or do you want to die with zero, spend as much of your money as possible? What rate of return is needed to sustain your withdrawals? If you're someone who has $5 million in the bank and you only want to spend $100,000 per year, then maybe you don't need to invest as aggressively because that is more than enough to fulfill your income needs. And then always, again, look at your annual expenses. A lot of people like to do what's called a bucket approach, where you have 3 different buckets. You put about 2 years of expenses in very low risk or no risk assets like CDs and treasuries. The second bucket would be another 3 to 5 years of expenses in very low risk investments like corporate or municipal bonds. And then you put the remainder of your money in that third bucket, which is going to be in the stock market so it can continue to grow over time. The idea here is that any money that's invested in the stock market, you're not going to need for at least 5 to 8 years. So you can sustain any sort of volatility that may occur in that bucket. But again, that's just one approach that a lot of people are familiar with that I wanted to just mention there as far as your retirement investing strategy. So one thing that I use in my practice and one thing that I think a lot of people need to understand is something called evidence-based investing. And basically that is taking a look at history and understanding that the financial markets have rewarded long-term investors. People expect a positive return on the capital they supply. And historically, the equity and bond markets have provided a growth of wealth that has more than offset inflation over the long term. So this goes back to just understanding that you're investing in companies when you're investing in the stock market. So these companies are always going to continue to innovate, drive profits, and drive value to their shareholders. So if you believe that these companies are going to continue to do that into the future, then you have to believe that the stock market is going to be resilient and continue to chug along as it always has. But to take it a step further, evidence-based investing also says consider what drives the returns of certain investments. So there's a wealth of academic research into what drives returns. Expected returns depend on current market prices and expected future cash flows. Investors can use this information to pursue higher expected returns in their portfolios. So what I mean by that is certain companies historically have performed better than other companies. So for example, you can look at the chart here. As you can see, small cap companies outperform large cap companies the majority of the time. That percentage sort of gets better the longer period that you look at. So dating back to 1927 through the end of December of 2023, On any 1 year period, small cap stocks outperform large cap stocks 55% of the time. And then as you can see, over 10 years, 68% of the time, small cap stocks are going to beat large cap stocks. Same thing with value oriented companies versus growth oriented companies, and highly profitable companies versus low profitability companies. But as you can see, none of these numbers are 100%. So you don't want to put all of your eggs into small cap companies, all of your eggs in the value basket, and vice versa. So you still want to be diversified, but sort of tilt your portfolio towards these companies that possess particular factors, with the expectation that they will continue to provide better returns over the long run. So again, that's the approach I take to investing. May not be for everyone because there are periods of time where they won't outperform. So you have to be prepared for that. You have to be very disciplined with this sort of investment approach, but something that I really think is the best way to invest. It's the way I invest my money, the way I invest most of my clients' money. So that's an excerpt on evidence-based investing. And then, as I mentioned as well in the beginning, you always want to focus on what you can control. What you can control is diversifying your investments. You can control the fees that you pay by choosing low-cost ETFs and index funds. But practice smart diversification. Holding securities across many segments can help manage your overall risk, but diversifying within your home market may not be enough. So people love to say that the S&P 500 may be all that you need in an investment portfolio, but that's only large cap US stocks. As you can see in the chart to the right here, US large cap stocks have not always been the best performer. In fact, over the past 15 years or so, you can see that there's really no rhyme or reason to which segment of the market is going to perform the best. So by diversifying globally through different sizes of companies and different countries, you can sort of diversify even further and take advantage of any segment of the market that's going to provide the best return in a given year. And as always, you definitely want to avoid market timing. You never know which market segment will outperform from year to year. By holding a globally diversified portfolio, investors will be positioned to seek returns wherever they occur. So, like I said earlier as well, every 4 years or so, the market will experience a 20% downturn. So you just have to understand that is just how investing is. It's how it always will be. So that when you experience that, you don't panic, you don't try to time the market, don't try to sell out and buy back in at a particular time to outsmart the market. So that is it for the presentation, folks. I really appreciate you all joining today. Just want to share a bit about myself and my partner, Chris, here at the very end. We are the co-owners of Spark Wealth Advisors. We're an independent registered investment advisor in the state of Florida. We have clients all over the country. We are a fee-only firm, meaning we only get paid by our clients. We don't accept any commissions for the sale of financial products, whether it be mutual funds, annuities, or life insurance. So we feel that that's the best way to do business, to keep a transparent sort of business relationship. We are fiduciaries, of course, meaning we are required to act in your best interest and not that of our own. So if you are someone who's considering working with a financial advisor to get the most out of your retirement, we would love to speak to you. We are currently taking on new clients. We do take on a limited number of clients each month, depending on how our calendar looks, but our priority is maintaining that white glove service for our current clients. But if you are considering that, we do offer a free retirement assessment where we will build out your retirement income plan, a tax plan, and that investment allocation that we went through in this presentation. So we do that completely for free to show you exactly what we would recommend for you if you wanted to work together. So feel free to schedule that at your convenience, and we would love to speak to you. Besides that, let us know if you have any questions, and thank you for joining.